You might be betting against Rupee by investing in mutual fund. Let's understand why in this episode of Market Secrets Investment Series. Before we begin, I have a notification for you. In addition to the investment series, we have multiple other learning series running in parallel on price action trading, algo trading, and trading strategies. Also, we are providing multiple data feeds for the intraday traders. So if you are interested in any of it, check out our website www.marketsecrets.in. And with that note, let's jump into today's session. So, are you investing in US or other global market funds from India? Then you might be betting against rupee. Let's try to understand how and why this happens. There are a lot of mutual funds available in India which can be used to invest in global markets, including the US, Euro, and other developed and developing markets. In order to get geographical diversification in our portfolio, a lot of us have invested in such global funds over a period of time. But most investors forget one important aspect when they invest in such global funds, which is the impact forex rates can have on their portfolio. Except for the Parag Parikh FlexiCap Fund, almost all other equity mutual funds in India that invest in global markets can be impacted by forex moves. Parag Parikh FlexiCap Fund hedges against forex move through currency contracts, so it won't have much impact. But due to this hedging, the cost of investing in the fund rises. That's why Parag Parikh FlexiCap Fund has the higher expense ratio. But if you take any other fund, they all have currency risk as they don't hedge the forex move. In any case, all your foreign investments are in fact subject to currency risk unless hedged. If you are an Indian resident, your investments would generally be in INR, but if you invest in the global market funds, say US market, your money will be converted from INR to USD and the proceeds will be invested in the US market. Likewise, when you redeem your investments, stocks will be sold in the US market and then the dollars received for the same will be converted into INR and the proceeds will be paid to you. So do you see the problem here? We are exposing ourselves to the USD-INR currency fluctuations here. If INR appreciates against USD, then your investments in the US would lose its market value and show up as a loss in your portfolio. The opposite is also true. That's how the risk works. So if INR depreciates against USD, then your foreign holdings become much more valuable as it is priced in INR. These forex movements would affect your portfolio greatly over time. So by investing in the global markets, in addition to the market risks that come up with every equity investments, you are also assuming one extra risk which would impact your portfolio. So, how to choose the funds for investing in the global markets? Let's take it scenario by scenario. Scenario 1. You think that INR will depreciate. So if you think the INR will depreciate against USD in the long run, say USD INR rate will hit 100 rupees in the future, then you can go for the funds which doesn't have to do the currency hedging. Because if you opt for the funds without currency hedging, then if INR depreciates as predicted while redeeming the global funds, you will get additional amount over and above the market returns. But if you opt for the funds with the currency hedging, then even if INR depreciates as predicted while redeeming the global funds, you will only get the market returns. So it is better to go with the funds without hedges if you think INR will depreciate over long term. Scenario 2. You think that INR will appreciate. So if you think the INR will appreciate against USD in the long run, say USD INR rate will go towards 50 or 60 in the future, then you can go for the funds which do the currency hedging because if you opt for the funds without currency hedging, then if INR appreciates as predicted while redeeming the global funds, you will get lesser or even negative returns even if the US market had generated healthy returns. This is due to the currency risk. But if you opt for the funds with currency hedging, then even if INR appreciates as predicted while redeeming the global funds, you will still get the actual market returns. So it is better to go with the funds with hedges if you think INR will appreciate over long term. Scenario 3. INR will stay around the same levels. So if you think INR will stay around the same levels, then it is better to go with the funds which won't do the hedging, as hedging generally has additional costs associated with it. And scenario number 4, you cannot predict INR move. So if you cannot predict what would happen on the currency rate, in that case it is better to opt for the funds which does the currency hedging, as the price you have to pay for judging it wrong is too high. So always keep these factors in mind while investing in the global funds from India. So, are you investing in global mutual funds? If yes, Are you using hedged or non-hedged mutual funds? Are you aware of the currency risk? And do you realize you are betting against rupee by investing in non-hedged funds? Well, let us know your thoughts in the comment section. This brings us to the end of today's episode. If you have any queries, comments, or feedback about this episode, leave it down in the comment section. We'll be happy to answer it. Also, hit the like button if you have liked this video and share it with your friends if you find it useful. Your support and feedback is the motivation factor for us, so please keep that coming. Also, subscribe to our YouTube channel and click the bell icon to get notified whenever we upload a new video or conduct a live session. Thanks for watching. Have a great day. Goodbye.